Most people spend $500 without thinking. A phone upgrade, a weekend trip, a few nights out. It's gone before they even realize it. But what if that same $500, used once, intentionally, could build something that pays you $5,000 every month for life? This video is a beginner's guide to a real strategy called smart dividend investing. I'll show you and Josh how you can start a simple portfolio with just $500. I'll walk you through how to choose the right stocks. And by the end, I'll show you how adding just a few dollars extra a day can grow into a $300,000 portfolio, one that pays over $5,000 a month in dividend income. In 2025, the average monthly salary in the US is $5,174, or about $62,000 per year. But that's the gross number. After taxes, most people are taking home far less, often closer to $45,000 to $50,000. And that's before essentials like rent, groceries, insurance, and debt payments. Here's where it gets real. While salaries have gone up over the past decade, so has everything else. Food prices are up nearly 3%. Rent continues to rise in most cities. Utilities, gas, and insurance are all more expensive. Inflation in 2025 is at 2.4% to 2.7%, which might sound manageable, but when your costs are rising and your savings aren't keeping up, it adds up fast. Even if your salary has increased on paper, your buying power may not have. That's the danger of inflation. It erodes your income and savings every single year. And if you're just keeping money in a bank account, you're losing ground. Most savings accounts offer interest far below the rate of inflation. That means your money is shrinking, even if the number stays the same. That's why investing becomes essential. If your money isn't growing faster than inflation, you're falling behind. But with dividend investing, even starting small puts you ahead. And for this video, I'm aiming to reach a portfolio valuation that will pay roughly what the average American gets paid a month. That is, over $5,000 per month in dividend income. Most people think investing is about chasing the next big thing, but the truth is real wealth is built slowly, and dividend investing is one of the simplest, most reliable ways to do it. When you invest in dividend-paying companies, you're not just hoping the stock goes up, you're getting paid just for owning the stock. That payment is called a dividend, and when you choose the right companies, those payments grow year after year. Dividends are proof that the business is making money, and they're willing to share those profits with you, the investor. And you don't need to pick risky or trendy stocks. Many of the best dividend-paying companies are boring, stable businesses that have been profitable for decades. That's what makes them ideal for beginners. What makes dividend investing powerful isn't just the income, it's what happens when you reinvest those dividends. Instead of taking the cash out, you use it to buy more shares. More shares means more dividends. And over time, your portfolio grows without needing you to add new money. You're earning income while you sleep, whether the market is up or down. That's what separates investors from traders. Traders try to time things. Dividend investors build things. And this strategy rewards the one thing anyone can control: discipline. All you need is a solid strategy and the willingness to stick with it. With time, dividend investing turns a small start into steady, growing income. When you start building a dividend portfolio, you have a few solid paths to choose from, and understanding your options will help you feel more confident in what you're buying. Let's start with dividend ETFs, or exchange-traded funds. These are collections of dividend-paying companies grouped into a single investment. When you buy a dividend ETF, you're essentially owning small pieces of many businesses at once. You don't have to select each stock individually. The ETF takes care of that by following a specific set of rules. This makes ETFs ideal for beginners because they provide instant diversification, reduce risk, and require minimal maintenance. Then there are individual stocks. These give you direct ownership in a single company. This approach lets you be more selective and strategic. If a company has strong dividend growth, stable cash flow, and a good track record, it may be worth owning directly. Individual stocks allow you to customize your portfolio and boost returns, but they require more attention and research compared to ETFs. You also have index funds. These are similar to ETFs but are built to mirror the performance of a broader market segment, like a country or region. Index funds are known for their stability, low fees, and long-term reliability. They're not actively managed, which keeps costs down and results consistent. For investors who want to play it safe and grow slowly but steadily, index funds are a strong option. Here's what's important. You don't have to pick one path. Many smart investors combine ETFs, individual stocks, and index funds into a single portfolio. ETFs add balance and simplicity. Stocks add control and potential upside. Index funds bring global exposure and low-risk growth. Together, they create a portfolio that works in multiple market conditions. This combined strategy forms the backbone of the portfolio that we'll go through next. It's built to be beginner-friendly, diversified, and to grow your income and wealth consistently over time. And at the end, I'll show you what happens when you invest $500 in a carefully crafted portfolio and how an extra $2 a week into this portfolio can grow into a $300,000 portfolio that pays over $5,000 a month in dividend income. But first, let's see the stock selection criteria. Choosing the right dividend investments isn't about luck, it's about having a system. When you're building a long-term income portfolio, you need to filter out the noise and focus on key indicators that lead to consistent returns. For me, first and foremost, I look at dividend yield. This is the percentage of income you earn from a stock relative to its price. A solid dividend yield gives you immediate passive income. However, a yield that is too high can be a red flag, indicating a payout that may be unsustainable or a business in trouble. I aim for a balanced yield that provides good income now and still leaves room for the company to grow. Next is dividend growth, how much the company increases its dividend each year. I focus on the 10-year compound annual growth rate, or CAGR. A high dividend growth rate over a full decade shows long-term commitment and financial strength. These are companies that reward investors regularly and build stronger future payouts. I also look for a good share price appreciation. This portfolio isn't just about collecting dividends. You want your investments to grow in value too. A company that steadily increases in price while paying dividends delivers a double benefit: income and long-term capital gains. Business durability is another key filter. I avoid hype, trends, or speculation. Instead, I look for companies that operate in industries with consistent demand, businesses people rely on year after year through all kinds of economic conditions. This includes companies in consumer goods, financial services, real estate, industrials, and global index strategies. I also prioritize resilience during downturns. Did the company continue to pay or even raise its dividend during market drops or recessions? That's a sign of smart management, strong financials, and a business model that can handle pressure. Lastly, I look at overall portfolio synergy. Each pick doesn't just stand alone, it complements the others. Some provide stability, some offer growth, and some maximize income. When combined, they form a portfolio with strong average yield, growth, and appreciation. This process helps remove emotion and focus purely on performance, reliability, and long-term potential. Now I'll show you the exact picks that meet all these standards and break down what makes each one worth owning. It starts with the Schwab US Dividend Equity ETF with a ticker symbol SCHD. This ETF is a go-to for investors as a core ETF for a portfolio. It is packed with high-quality US companies that consistently pay and grow their dividends. With a yield of 3.75%, a 10-year dividend growth rate of 10.77%, and an annual price appreciation of 7.69%, SCHD hits the balance between income and stability. For global diversification, the portfolio includes Vanguard's European Stock Index Fund with a ticker symbol VEUSX. This fund tracks large-cap companies across Europe, offering steady income and reduced volatility. It has a dividend yield of 2.93% with a 13.18% dividend growth rate and 3.47% annual share price appreciation. It's the quiet backbone that helps anchor the portfolio. Next is CubeSmart, with a ticker symbol CUBE, a real estate investment trust focused on self-storage. This business thrives in all kinds of economic conditions, making it an ideal choice for defensive income. Cube pays a 4.91% dividend, has grown that dividend by 13% annually over the last decade, and has increased its share price by 5.43% a year. It offers both consistency and dependable cash flow. Then we have Tractor Supply Company, with a ticker symbol TSCO. Serving rural communities across the country, TSCO has carved out a dominant position in retail. More than just stable, it's been a dividend growth powerhouse. The current dividend yield is 1.62%, but the 10-year growth rate is a staggering 20.8%, alongside annual share price growth of 11.87%. This is a long-term wealth builder. Lastly, we have the Federal Agricultural Mortgage Corporation with a ticker symbol AGM. This company supports America's agricultural economy and flies under most radars, but its numbers are outstanding. A 3.38% dividend yield, a 25.47% 10-year dividend growth rate, and a 17.03% annual share price appreciation. It's a high-performance dividend machine wrapped in a modest-looking stock. The next step is to calculate your portfolio metrics, and it is fairly simple. To calculate the average dividend yield of the portfolio, you first take the dividend yield of each stock in the portfolio. In this case, we have 5 investments: SCHD, Cube, TSCO, VEUSX, and AGM. Their current dividend yields are 3.75%, 4.91%, 1.62%, 2.93%, and 3.38% respectively. Next, you add all of those yields together. 3.75 plus 4.91 plus 1.62 plus 2.93 plus 3.38 equals 16.59%. Then, since there are 5 stocks, you divide the total by 5. 16.59 divided by 5 equals 3.32%. That 3.32% is the average dividend yield across the portfolio, meaning on average, your investments are paying you that percentage of passive income each year based on their current price. You can use this exact same method to calculate the average dividend growth rate and average annual share price appreciation too. For this portfolio, the average 10-year dividend growth rate is 16.64%, and the average share price appreciation is 9.1%. Now let's break down exactly what happens when you invest only $500 into this dividend portfolio, a one-time investment. After year 1, your investment will be valued at $600. By year 10, the portfolio grows to just over $2,000 and dividend income reaches $100 a year. By year 20, your portfolio value hits the $10,000 mark, and your annual dividend income would be around $1,000. And then comes the exponential part. Fast forward to year 30, and that portfolio would grow into a $132,000 portfolio, paying around $26,000 a year in dividend income. That's over $2,100 a month. $2,100 a month is good, but it's still not the $5,000 per month we're aiming for. So, let's supercharge the portfolio. Let's take it a step further with a plan that adds just $2 a week. That's $100 per year. It's not a huge commitment, and that's the point. This isn't about making drastic changes or cutting your budget. Each week, that $2 adds a little more buying power, a little more compounding, and a lot more future income. Let's look at how it changes the outcome. By the end of year 1, your portfolio will be at $700, and it's generating the same $20 in dividends. But if you keep going, by year 10, that portfolio will grow to around $4,000. That red line of your dividend income starts to curve upward after that. That's the first sign of compounding starting to work for you. Now fast forward to year 20. Your balance will be around $24,000. From the years 20 to 30, everything accelerates. Your portfolio explodes from $24,000 to $312,000, and your dividend income around that time would be $63,000 per year, over $5,200 every single month. Now, let's compare the dividend income of both scenarios. This graph clearly shows the difference between 2 long-term dividend growth paths, a lower growth strategy and a higher growth strategy, starting from the same point but ending in very different places over 30 years. In year 1, both strategies only generate about $20 in annual dividend growth. That's not much to get excited about, and that's exactly why most people don't realize the power of compounding dividends. But by year 10, things begin to change. The lower growth path is up to around $100 in annual dividend income, while the higher growth strategy has already doubled that, bringing in $200. The compounding effect starts to show itself, not dramatically, but noticeably. Then by year 20, the gap really starts to widen. The lower growth path reaches just over $1,000 in dividends, while the higher growth path has surged to more than $3,000. At this point, it's no longer a small difference. It's a significant gap, and it's only getting wider. By year 30, the difference is huge. The conservative path brings in $26,000 per year, which is great, but the higher growth strategy is generating over $63,000 annually. That's more than $5,000 per month in passive income. Want to see how just $10 a day can grow into $1 million portfolio and pay you over $10,000 a year in dividends? Click the video on the screen.